Welcome back to the Wealth Juice podcast. As always, it's your boys, Ryan and Corey here with another episode for you. Today, we're going to talk about two things that hit the news headlines that I think are important to talk about for investors and consumers, and that applies to all you listeners, is the two main headlines that stuck out to us where they're talking about 50-year mortgages and another $2,000 stimulus check getting infused into the market by Trump. So with this, you'll take a hit or you will be in an astronomically great spot depending on what you decide to do. And I'm not sure if either of these are actually going to come to fruition, right? These are just thoughts and proposals, but we did want to talk about this because we thought they applied to us. And so I think the first thing that you see when you read these, like at first, they both sound like good things, more affordability and then more money in your pocket. But when you zoom out, these are signals that the economy isn't in the best spot and they're trying to infuse capital into it to make it look and function appropriately. Everyone knows we're in this big debt crisis here. And it's funny that we just keep kicking the can down the line and pushing the goalposts further and further away. To me and to Corey and I, we kind of talk about this. It seems like this never ending game of like, we're not getting out of this debt crisis. There's just printing more dollars to stabilize things. And at some point, someone's going to have to pay for this, right? So we're going to talk about how the wealth gap continues to widen and how we see there's either a lower class or an upper class. The middle class is kind of eroding. And we've talked about this in a couple different episodes, but these are two prime examples of things you're seeing today in the market that they appear amazing. Wow, I could really use that $2,000, or wow, 50-year mortgage. Like I can afford a home now because my payments are going to be much, much cheaper. But in the long run, you're going to be paying a ton of extra interest. And in theory, you're paying way more for the home. So we'll dive into both of these, but Corey, I don't know if you have any thoughts right off the rip.
Yeah. So, I mean, I was just like, I have this calculator out here. I was just doing some math. So we don't really get political on this podcast. It's kind of not necessarily by intention. It's just like not something that like I even really feel like going into. So it doesn't matter if you like Trump or you're Democrat, Republican. None of this matters. It's just the fact that is what's happening is that no politician wants to look bad on a social media landscape to the public. So by not wanting to look bad, what's happening is that they're not allowing any recessions to happen. Like we won't allow an actual natural occurring recession to happen in the United States. And that's why you're seeing this print, is because no one wants to be known as the president or the administration that had this bad recession. So what's happening is that the American people are paying for this silently. That's what's happening. So I just did some math here. A $2,000 stimulus check, which by the way, would significantly help a lot of the country. So I'm not saying it's all bad. Like that money would help a solid portion of the country, especially like lower class or lower middle class. And that's fine. But if you did 200,000 times 350 million, I think my math is right here. There's so many zeros. I don't know. I think it's 700 billion. It's more than 70 billion. I think it's $700 billion. Somebody check me on that. But the point is that money is now getting infused, coming from the money printer, getting infused into the country, into your pocket. So you think you're getting $2,000 richer, but what's actually happening is $700 billion is now being added in liquidity to the environment, and which devalues the actual dollar that you have now. So we've talked about this in a number of podcast episodes. The value of the dollar in the last 100 years has went down 99%. In the last 5 years, it's went down 25%. So your $1 in 2020 is now worth 75 cents. All this is doing is making that exact dollar worth less in the future. So your $2,000, by the time it gets prior to print to post print in your pocket, it's probably worth $1,700. And that because, and again, this is not like, I'm not doing math live in front of you. I don't know the actual inflation stats, but the point is that it's not even worth what you think it's worth. So your dollars that are able you to go buy coffee and go buy your car and go buy a house is going to be worth significantly less, which is going to rise asset prices more. Bitcoin, stocks, real estate, all are going to go up eventually, right? And they might have flux and whatnot, but long-term, they're going to go up eventually. So then you have the 50-year mortgages coming in. And what that's doing is allowing people to have a little bit less of a mortgage payment. And by the way, 30-year to 50-year, it's like a few $100 a month. It's not even that much. But the interest that you're adding on the back end of it is like, could be like double the amount of interest. So I think I'm leaning more bearish, like not liking this idea as much, the 50-year mortgage, as opposed to liking it. However, I do think that there are some benefits for people to lock in fixed debt today because your debt and your dollars today is worth more than your dollars in like 30 to 50 years from now. So that's like my initial hot take at the beginning. And we can get into like why this is happening and the ecosystem, but that's my broad overview.
Yeah, no, nice touch. I think the problem we're trying to solve here right now in America is, right, home prices are high, interest rates are high, wages have not kept up, right? So what do we do? Like, the average American is saying, I can't afford a house. The government from there says, okay, we have two options. One, let home prices fall. This would hurt homeowners, banks, builders, and the economy. Or we make payments look cheaper, right? Without lowering home prices, this is essentially welcome to the 50-year mortgage, right? To have more people able to buy homes, to be able to afford them, right? And it does a lot. It just cracks through the entire economy, and I think people are gonna be hit in a lot of different ways. And so just to kind of break this down a little bit more, it's like saying, I can't afford a $700 a month car payment, so the dealer says, no worries, I'll make it $400 a month. The loan's just going to last 15 years. And so in theory, it sounds great. You're like, okay, I can take this car home now today with a cheaper payment. But in time, if you crunch the numbers on this interest, you're paying 2 or 3 times what you would pay by just buying the car at the cheaper rate earlier in the beginning. So or the more expensive rate, I should say. So
this happened to me, by the way. I remember when I first got my car, I was like, oh, I don't want to pay more than $300 a month. And that's the worst thing to tell somebody who's like running a car dealership, right? Because they're like, oh, great. It was 48 months, but you can do it over 72 and your payment would be $250. It's like, oh, nice. I didn't know anything. So that's exactly to the point of you're saying. That's what's happening with the housing market, or with the influx of a potential 50-year mortgage. But I also want to keep in mind for people that the 30-year mortgage came out in the 40s and 50s. So it's not like it's always been, it's a new idea, right? And like, I think new ideas are oftentimes good. And maybe it's just an adjustment to like the times that we're in and what we have to do. So 30-year mortgages weren't always around, and they didn't even really come into play a lot until like the late 50s or 60s. So I think that is a way for banks to get richer, right? I mean, that's inevitably you're paying the bank, and people do know, the average lifespan of your mortgage with one person is like 7 years. So most people hold on for 7 years and then it gets sold anyway. So I don't know that they're going to go the life of the term, but it's a way for banks to collect more interest. And you're right now in the first 6 to 8 years, you're paying down basically not no principal pay down, but very little principal pay down. Your principal pay down around year 7 is when it really starts to like kick up a little bit. Imagine the 50-year note, dude. It's going to be year 17, 20 before you're paying that down. So for people that are investors and you're buying rental properties, if rents continue to go up and mortgages stay flat, even the 50-year note, you'll probably have more margin. But what does that do? That makes home prices more expensive and rent more expensive. So I just don't know if it's solving the problem that we're trying to solve. That's what
it's interesting to me. I see it like current investors and asset holders are going to benefit the most from this, because it's just going to be a competition once again. Even as soon as they roll this out, or if they roll this out, right, there's way more competition in the market now, because not only do you have this brand new stimulus check of $2,000, but you feel like you have more money and that can add to it. But really the 50-year mortgage is just saying, hey, we're going to take people who are they weren't able to get a loan at 30 years. So they're less bankable, but now there's more competition because people with less can get in. It's just going to drive up the price of a home again. So the people that are currently holding assets that can afford the 30 years, or maybe the 15 years, those are going to be the real winners. And they continue to print. All of the assets you hold in the ground are going to continue to rise over time. And that's when Corey and I say, it's important to get into the game, because you don't know when things like this are going to happen. It just depends on the presidential regime that comes in, whether it's blue or red or whoever. They can sign things into existence, and then you have to pivot on a dime. And based on what you've done in the past is kind of how your life plays out. And so for us, that's why we've continued to preach this year in and year out, and episode after episode, is like, get into the game, so that way you can at least start playing on the chessboard, and you can pivot when things happen, right? For us, I don't think this is an amazing thing for the overall economy, but I do think for us holding assets, it's going to go a long way. And we listen to a lot of podcasts on Bitcoin too. And I encourage people, if you don't listen to the show, or if you are interested in learning more, the Jack Mallers show is amazing. And he does a great way of does a great job of explaining the debasement of the dollar and how this really plays into the political landscape, the economic landscape, and all of the above in 2025. And he specifically talks about Bitcoin, but a lot of it overlaps to real estate too. And it's just holding these assets and protecting your wealth. So he says money is our time and energy in abstract form. So when it's devalued, so are we. And I think that's super important. Like we go to work every single day, right? Whether you're an entrepreneur, whether you go to your 9 to 5, and you're grinding and you're putting your time into this economy and this society to be in return exchange for dollars, right? But if those dollars are continually getting devalued, so are you. It's saying like, why go work all these hours and we're just going to continue to pay you less. So I understand why there's this big friction in the world today, because the people that the upper class, right, are like, hey, we don't care, devalue the dollar, that's great because my assets continue to go up. And then the lower class is like, you're devaluing this dollar, why am I going to work every day? I can't even go pay for eggs. So you can see there's this big tug of war going on. And once again, I'm just trying to reinforce, like, getting into the game as soon as you can to lock in fixed debt is very important, because you see the printing machine just keeps going every couple of years. And if you hold for the right amount of time, you're going to be set up in a really good position to give yourself optionality. And when I say by optionality is you are getting someone to, we talk about real estate all the time, so I'll just equate it to this, right? We talk about all the benefits of real estate, but what for us is like, you're having someone else pay down your mortgage. You're building equity into an asset. So that way down the line, you're able to draw off of that if you'd like to, meaning, a home equity line of credit, if you want to pull off that to go pay for another investment property. If you have made a certain amount of money in appreciation because of loan pay down and the value going up, you can then sell that property and trade up for another one or another, maybe a duplex or a quadplex. So you're giving yourself optionality to do the things you want. You guys could say, hey, well, I don't want to buy more assets after that. I bought this so I could live my life. Great. Go pay for your wedding. Great. Go pay for a primary residence. Great. Go do that vacation, your bucket list that you've always wanted to do. Just having the ability to live your life differently. This is what Corey and I are realizing. Like, as we've gone through this game, we still have a lot of friends that work the 9 to 5 life, and I see how hard they're struggling. And we have a random property that sells and we make $100,000. I'm like, oh my God, dude, like that in years past, that would have taken me, after tax money, that would have taken me 2 years to save up that amount, right? After all expenses and things are paid. So it's making us realize, like, in real time, like, we're able now to do the things that we want to do because we invested in our education, invested in assets young. And I say that, I put out an Instagram post the other day. It's like, if you don't stack assets in your 20s and 30s, your 40s will be chasing,
like catching up, right?
Yeah, you'll be basically behind. And we're getting to that age. We got, another 5-6 years till we hit 40. And I'm like, dude, thank God we did this. And that's why we're preaching to the masses. Like, I'm not sure the age of people listening, you probably range from mid-20s all the way up to the 50s. But my point is, the earlier you can get in, the better. And getting around the people that are doing it is just going to help you further increase your trajectory to reach that financial freedom number, or just that freedom number. It doesn't have to be financial freedom, just the ability to do what you want when you want and pursue the passions that you want to do on a daily basis. Maybe you don't want to punch a clock every day and just know that Uncle Sam's taking money out of your pocket and your value of your dollar keeps going down and you just get upset. I feel like there's this big tension here within the world, and especially in the United States.
And by the way, if you're in your 40s or 50s, it's not too late. So like, I don't want people to think that. It's just that, like, the earlier you get started, the better, right? And that's 100% true. If you're in your 40s, like, rock out, like, let's make this thing happen. Like, you can still do it. But I want to talk, like, briefly about the disenfranchisement that's happening with young people. And this is why we're seeing with the wealth gap widen significantly, right? So like, I don't blame people, like, I didn't really want to bring this up, but like, you just saw the new mayor of New York get elected. Like, he's like, have a lot of like socialistic viewpoints, and like, there's a reason why this happened. There's a reason, because people don't think that they can afford their life. So I don't think it's a solution. And I want to be clear. I think it's not the solution, but I understand why people think that way, that he can help save you. And I think the more that the wealth gap widens, the issue with people saying like, oh, tax the rich is like, the people that get taxed the most are the W-2 earners, based on the code that was written by our system. So like, you either get played by the game or you play the game. So when you say like tax the rich, like, those people aren't W-2 earners. They understand they're playing the game on a different wavelength. So they're going to avoid, legally, most of them are going to avoid ways to get taxed, because the biggest taxes come from the W-2 population. So I think that's really hard for people to like hear. And again, this isn't a political statement. I'm just like giving my opinion of what I'm seeing here that's happening. And I think I understand why young people are struggling. Like, and we have been through that struggle too. Like, we're not like independently wealthy, like to a point where it's like just easy money. I think that like I'm seeing things in my life cost more money. I'm so glad I have assets that are rising faster than the inflation that's going up. But I understand where people are at and why they're thinking this. That's why it is so imperative to buy real estate or to buy assets. Like this $2,000 stimulus check or the 50-year mortgage, they're all signs that our dollar is decreasing in value and decreasing in value. And I don't know what happens in 15, 20 years from now. I really don't. I really hope that it's not the haves and the have-nots completely. Like people already might think that's America and the way it is, but there still is a middle class. And there needs to be, in my opinion, there needs to be a thriving middle class for our country to be great, to continue to be great. And I don't know. All I know is that like you have to look at the signs, and like these signs are definitely pointing in the direction of like, just think about this from a governmental standpoint. Like if you're getting handed $2,000, like there's a back door of where this is coming from. It's not just, and if it is out of thin air, then the dollars that you have are like they're becoming worth less. So you have to just envision, like see the bigger picture a little bit is what I'm saying here.
Yes. And, anytime money's infused into the economy, people are going to put these dollars into what they know. If you know assets,
Exactly.
you know how to build wealth, you're going to put it into stocks, you're going to put it into cryptocurrency, you're going to put it into real estate, you're going to put it into those things. Maybe you're going to buy a business. If you're not as savvy and you're a product of your environment growing up and you just have never studied this, you're more likely going to say, okay, cool, I can put that in my checking account, which is losing money to inflation every single day. I'm going to go pay for my groceries. I'm going to go pay for my bill. I'm going to go pay to go to the movies or whatever it may be. But you're just like the things in your life that are fleeting, you're going to pay for. And then that $2,000 stimulus check is going to go away. And other people that are putting it into the assets that are growing, it's rising those assets again. So it's then pushing the goalpost even further again, making it harder for those who have never invested in assets to get in. So my point is this, it's a perpetual cycle that continues to go. So the earlier you can self-educate, and that's why we try to get this to the masses, like you can learn this at a beginner's level, just get in the game, and it'll eventually start taking off for you. And it's a slow burn in the beginning, but that's why it's important to us. We started with a single house hack and we've built a multi-million-dollar real estate portfolio. And I don't say that to say we're not living off of multi-million-dollars in a month, but if shit hits the fan and we need to, we can offload a property. And we can kind of reallocate funds to things. And we've been able to do this in real time in real life situations when we're like in a pinch. We're like, we need to move on this. And having liquid assets, even today, we're looking to sell one of our properties, and I found like this is kind of contrary to what I just said, but there's different ways of liquidity in your portfolio. And I think it's important to have some things that are in the ground. Real estate's amazing and it's a cash flowing machine, right? That's your money printer as an investor. But sometimes it's difficult if you have to offload a property. You have to wait to sell it at the right price. You have to wait for people to get approved to buy it. And then you go through the process. Sometimes it can take 30, 60, 90 days. Now, having liquid assets and specifically cryptocurrency, Bitcoin, that is something where it's kind of like a new regime. Not everyone's into this yet, but Corey and I are really getting into this. And it's really important to have something that's gone up above every other asset class over the last 15 years and know that I have that liquid cash if I need it. I can go sell that, roll the Bitcoin into a stable coin, pull that stable coin, put it into my bank account, and I'm off to the races that day. And if I need to send Corey money, I can send it to him in 2 seconds and I don't have to wait for the bank. I can send him some Bitcoin. I can send him this because we have each other's wallets, right? It's a simple transfer. And I think it's so important. I'm seeing that around the world. There's people that are unbankable and they don't want to, they could be a country far away, a third world country. And these guys, they can't even go get a bank account, but they can open up a Bitcoin account and they can transfer money to each other. And that's how they get paid. So there's so many, it's a global asset, right? And that's something that is newer. I don't want to take over this episode about it, but I'm super focused on that too, because, Corey and I have been in a couple of different pinches. We're like, man, we really need this cash right now. But we're lucky that we have our asset mixed around to a bunch of different things where we haven't felt the pinch. We're like, okay, we can hold the real estate until it sells. All good. Let's we'll use Bitcoin for this one, or whatever, or sell some stocks. So
no, I think that's really well said, and it's like another reason why history doesn't always repeat itself, but it leaves clues, and that's so like what's going to happen here. And just talking about that with this stimulus, if it does end up happening, is it looks good to the commoner. But like, let's just talk about what happened last time. During COVID, after April 2020, stocks, everything. Well, I guess real estate, it doesn't really happen like overnight like this, but stocks went down like 30 to 40%, right? So everyone was freaking out, and within, I think it was 30 to 60 days, they were already back at all time highs. So because of the infusion of the cash into the market, and Bitcoin went from 8K to 69K. The S&P 500 and stocks soared to all-time highs. Real estate went up 40 to 50%. Like, think about what happened in Austin and Tampa and Phoenix, all these markets that went up 40 to 50% that are now seeing a little bit of drawbacks, not to the extent that they were before. We'll never see, in my opinion, we'll never see pre-COVID prices again unless there's like a World War III. So the people who own those assets instantly got wealthier, after the volatility shook out. And the people who held the dollars, you started to see everything rise. So just keep that in mind as these new proposals come out. Like, what does that mean? Not now, not today, not my $2,000 going into my checking account today, but what happens in 26, 27, 2028? Like, that is where people need to be thinking. And I think the sooner you get on the asset side of things, everyone's a consumer. We're all consumers, but as soon as you have the thought process of, when I get money, when I make money, how does my money make me more money? You will soon become on the side of things that this benefits. And Ryan and I are not sitting here saying that we're so thrilled. Oh my God, like all this, like, we're not thrilled, because I want a thriving America for everyone. Like, I truly do. Like, and I hope that resonates. I hope that rings. You can hear it in like the way that we speak about things. That's why I'm saying anybody can get started in this game. We were nobody special. I was making $35,000 a year when I bought my first property. Anybody can make this happen, but the sidelines is the wrong place to be. It's just the wrong place to be. So, like, you either gotta buck up and figure out a way to do it. Obviously, we have a mentorship. We can help you buy real estate, or figure out a way to do it on your own if you want to go that route. But like, you can't sit idle any longer, because if history does repeat itself, if it does leave clues, 2030 is going to look so different than 2025. Like, and I mean different in the sense of like automation, potential job loss, new job created for sure. I think the economy could be in a different place in a good way, but your $500,000 home is going to be worth significantly more. Your assets are going to be worth significantly more. So get in now. And I know we've kind of repeated ourselves a little bit throughout this episode, but like, we're hammering this home to people.
We have to, and I'm going to repeat again. I just want you to understand this. Money is our time and our energy in an abstract form. So you are going to work to make dollars, but if those dollars are getting deflated and devalued, there's the issue right there. Your time and energy are getting devalued. That means you are not doing the right thing. And so what I'm saying is, this, as soon as you can get it through your head and understand that the game isn't changing, it's going to continue to go in this cycle where the government does not want a recession. The government does not want a housing crash. The government does not want pension insolvency. It doesn't want bank failures. So what is the only option for them to do? Turn on the faucet, print money, extend loan durations, inflate asset prices. It's the only way. So it depends on what side of the coin you're on here, right? And some people are already in the bucket where they're like, this is amazing. I have assets. This is great for me. Then there's others that don't. And they're like, how do I get in? So that's the point, is like, you need to educate. Use this as a window or as like a warning episode to say, okay, I get it. Now go study and learn. Don't just take it from us. There's a lot of people talking about this, and I can talk about, macroeconomics all day long because I'm obsessed with some of these guys. But on the real estate side, we got you. There's a bunch of people we can put you in the right direction too as well. But if you want to learn about the economy a little bit and you want to learn about macroeconomics, there's two people that I really like. One, Jack Mallers, I already mentioned him. He's a young cat, owner of Strike and 21. I think he's like 35, but he has been studying Bitcoin since he was like 15. And his dad was big, I think in either Goldman Sachs or in Chase. I forget exactly, but great guy to learn from. I listen to his podcast episodes every single week. And then Raoul Pal, he's a macroeconomics. He worked for Goldman Sachs forever. And he just basically studies the charts of liquidity, the business cycles, and how they all play together and overlays charts. And it's really, really interesting, and talks about the history of the dollar, history of the world, and like how this all plays together. And what you come to realize is this game, I think a lot of us are really focused on the United States, but it is global. And that is the thing. Once the United States starts printing money, every other country has to start printing money too. And all of that money gets pushed into assets in different types, right? You see gold skyrocketing, silver's, right behind it. Think about now what's digital gold, what's digital silver these days? Bitcoin, Ethereum. Just it's the world is changing. I'm thinking about all these young kids, Gen Y, Gen Z. It's like they're more scared to go open a Fidelity account, but you know what they're not scared to do is open a Robinhood account and dump some money into Bitcoin, dump something into Ethereum because they think it's going to jump in value and they see the spikes. Like I can make a quick hit versus having to wait for 30 years. I'm not saying that's the right way to do things, but I'm saying new money coming in is only going to inflate those who have cash in those different assets. Real estate, another thing. People that can't afford homes, they need to rent homes. Who are they going to rent the homes from? The asset owners. So it's one of those things like we can't change the game. That's my point. Like Ryan and Corey are not changing the game. We are just learning the rules and we're playing by them. So that way we can change and help, grow our family's wealth, but also just grow our freedoms. Like to be able to just go buy some land, to go eat a steak and eggs and salad and like have great food and experiences in the world. And I feel like it's really hard for a lot of people today. And that basic necessity, right, to have shelter and food, most people don't have it right now. They're buying tasty cakes and they're buying the cheapest things and just poisoning themselves by going to the grocery store because that's all they can afford. And It sucks. And it's not great. And so there's layers to this thing and we can talk about the personal, the political, all the above. But my point is, warning episode to say, not even a warning episode, but just like trying to like scream it as loud as I can for those people in the back. Like you need to get into assets that produce value, that increase over time, and then produce cash flow. And there's a bunch of different ways to do this. And your asset stack, you don't have to go into one thing. It doesn't have to be just real estate. It doesn't have to be just crypto. It doesn't have to be just stocks, but find a blend. There's a lot of information out there. Do your research. And sometimes simple is the best way to go. Don't overcomplicate it. Get yourself into a tizzy where you're studying everything left, right, up, and down. And then you don't take action. You're like, I'm just going to stay with doing what I'm doing. That's not the answer. We're prime examples of this, and you just can't fear the failure. Like we're all a number is my point. And I think that Corey and I realized this. We were going through the motions at our 9 to 5 and we're like, dude, what we got to take some risk here. Like, what are we doing? If not, I know the alternative. I know I'll just going to be doing the same job until I'm 67 and struggling and taking vacations a couple times a year, eating garbage, and it just sucks. And you see some of your friends doing it and you're like, please, here's the resources, listen to this, read this, blah, blah, blah. And there's just so much noise out there and it's hard for people to cut through it. So take it seriously. I don't know what else I could really leave you guys with. Corey, do you have anything else?
Yeah, I just think that by listening to this podcast, you're already not burying your head in the sand. But I will guarantee you that 90% of people will just bury their head in the sand. I don't want to deal with the money thing. Like I'm not an investor. I'm not this. I'm like, if you care about your family and you care about the future family and generations to come, then you got to learn to play the game. We are not the guys that are like money is everything, like greed, like at all, dude, like at all. We don't want that to be who we are, but it's like, there's a level of freedom that you can get to. There's a level of understanding about how this game is played that makes you a better person, a better individual, and you have to be able to share your message with others. So just leaving you with this, go look up like quantitative easing and like, just go look up. That is another kind of roundabout way, more complex way of saying like the money printers being turned on. So just like look that up, look up, game theory. Like these things are interesting topics of like what you can predict things that are going to happen in the future. We don't know. We don't claim to know. I'm not saying we're experts. I'm just saying we've success leaves clues, and the people that we've interviewed on our podcast have told us things. So we're telling people that are listening to our podcast. So stay in tune. I also want to know if people like these episodes where we're talking about like current events and stuff. It inevitably gets a little like into the political world and stuff. And we try to like stay out of that just because it's just so polarized and I don't really want people yelling at me. Like, I don't really care what you think in terms of like which side you're on. It's just like, I'm just going to try to give you what we think, you know what I mean? So, this is more of a real life episode of something that's happening right now for us. And, so just know that if you do get a stimulus check for $2,000, it's not a gift, use it, put it in some assets, or if you have enough assets rolling and you already have a system, fine, go do whatever you want with it. But just realize like where it's coming from and how it's being put into the system, and then continue to buy assets, because your life in the future, the physical life and the mental life and the emotional life that you live, will be better off because of it. So that's all I got. Thanks for tuning in, and twice a week going forward, tune in.
See you next week.